The information featured in this program is general in nature and therefore should not be relied upon. Guests appearing on the program may have commercial arrangements with some of the companies mentioned. Before making any investment, insurance or financial planning decisions, you should consult a licensed professional who can advise whether your decision is appropriate for you.
Hello and welcome to your Monday night property edition of Your Money, Your Call. I'm Margaret Lomas. Sydney's spring property selling season showed the first signs of coming to life at the weekend, with government policy initiatives and data released last week pointing to this trend continuing. The weekend's auction clearance rate rose to 60.7%, much higher than the previous weekend's 51.8%, and more significantly, the highest weekend auction clearance rate in nearly 2 months. More than 350 properties were listed for auction in Sydney at the weekend, about the same number as on the previous weekend. And one of the big four banks has vowed to beat any home loan rate advertised by its rivals a day after claims that an economic tsunami is set to hit the property market. The Commonwealth Bank is guaranteed to better the mortgage rates ANZ, NAB and Westpac promote until the end of the month. The offer applies to new and existing customers who take out a fixed or variable rate loan worth $100,000 or more. Now, with me tonight in the studio and ready to answer your questions is Ben Kingsley from Empower Wealth and Anthony Booth from BMT Tax Depreciation. So I've got plenty of expert help waiting by to take your calls. Now, you might have a question about buying your first or next investment property, or one about depreciation. Whatever you want to know, we're here to help you. If you do have a question, you might like to get in early by calling us on 1300 30 34 35, or if you'd rather write it down, you can, and then you can email it to us at property@skynews.com.au. Welcome to the program, and welcome to you both.
Thanks for having us on, Margaret.
And so this move to go out and get mortgage customers ahead of the economic tsunami, Ben, two questions in regard to that. First of all, what do you think about the economic tsunami?
Well, Margaret, I think we've got to take a big, deep breath and put everything into perspective. As I say to my clients, there's 8.6 million properties in the Australian property market. Now, as investors, we don't buy the market. We buy one at a time. If we do our research well and we look inside markets within markets within markets and we find those opportunities, I suspect we're going to miss that tsunami.
I think you're right. You know, I know that there's been a little bit of press over the last 24 to 48 hours, which are pointing to the fact that we might have avoided the major crisis during the last financial crisis here in Australia. We're a bit preserved from that. A lot of experts are saying that we're not going to be preserved from this next lot. I'm not sure that I understand what's different and why we could survive one and not the other.
Well, let's put it into context. When the last GFC hit, property prices actually went up. Interest rates came down, made property more affordable, and we saw that demand driver steer properties in a forward or upward direction. If the same occurs, we've got some leverage in interest rates to bring down those interest rates, potentially improving affordability. Now, there are some pockets of the country where affordability is quite tight, so I suspect in some of those markets we're going to see an adjustment in price. But in terms of the fundamentals that we look at that drive property values over the longer term, I think they're sound.
Certainly during the last global financial crisis, we found that high-end property definitely suffered. And because of the high prices on that high-end property, their falls pretty much wiped out the gains that were being recorded in those lower end markets. It made the market as a whole look like it was falling, but there was really a two-speed market happening there, with the lower end property doing very well and in fact growing during that time.
Correct, and the Melbourne market growing, and you know, good markets were doing well, and inside those were sub-markets which were also performing well as well.
Absolutely, and that's what you need to look out for. Anthony, I guess over at BMT you get a bit of a barometer on how property investors are feeling. Yes. What are you finding in terms of demand for depreciation reports at the moment? Is that slowing or is it picking up? What's happening?
No, look, it's definitely picking up, Margaret. we're seeing massive growth in terms of investors relying more so on depreciation these days to build their portfolios. It's an added bonus at tax time in terms of getting more cash back off the ATO for your next purchase. Certainly helps on new properties, but also older properties as well will also attract high amounts of depreciation.
And I guess if people were fleeing the market, as you would expect to happen before an economic tsunami, we should be seeing the waters receding at the moment and all be running for the hills. You'd be seeing that at BMT with less demand for your services.
It's funny, it's actually increased. There's a lot more activity there in the investor market with depreciation schedules. They're all wanting to maximise their returns at the end of the day. And look, there is doom and gloom out there about the market, but in terms of the existing investors that are looking to expand, now's an opportunity, and obviously depreciation can help that at the end of the day.
Now, I don't find that funny at all that your business is increasing, because I think that wise investors do know that providing they put in place some risk mitigation strategies, such as having landlord's insurance, making sure that they don't overcommit to a mortgage that they can't afford to support it with interest rate movements, and providing they invest in those markets that we know are a little bit recession-proof. Some of those markets where during a GFC they tend to not only grow in value but grow in demand from renters. I think smart investors know that this is actually an opportunity rather than a threat. That's
exactly right. And it's up to us to educate these investors that don't already know about depreciation, as stats out there roughly say about 80% of investors aren't aware of depreciation and the great benefits that it holds. So
that surprises me, because a lot of people read my books and I always talk about it.
Look, Margaret, I know you're always a big pusher of depreciation, but for people that watch the show, they're learning all the time, and it's just up to us to educate investors as to maximising their deductions.
Okay, great. Look, I'm going to take some calls now, and I'm going to come back later on because I want to know what things people miss typically in depreciation claims. But for now, Michael from Sydney, you're on the line and you've got a question to ask tonight.
Yeah, look, I just wanted to inquire. Everyone talks about property going down, going up, etc. But at the end of the day, it's always about a long-term hold, and I've held property for many years now, and you agree that you just got to ride through it no matter what.
Yeah, look, and I'm glad that you've called with that comment, Ben. People do forget the fact that property isn't one of those short-term things. It's not like the share market. We know that we can't get rid of it quickly, and therefore the best part about property is to actually, or the best thing about owning property is, so long as you know that you can hold it for a period of time, you can ride any of those short-term tsunamis.
Definitely. I mean, you've got the regular rent coming in, which is assisting with controlling the asset that's going to grow over the long term. And that's right, let's remind everyone, property is a long-term investment. I consider short-term 7 to 10 years, medium-term 15 years, and long-term indefinitely. I mean, it's continuing to deliver that income, which is really the passive income that we're going to live on as investors.
Having said that, and I guess that points to a saying that a lot of property people like to have, which is it's not market timing, it's time in market. Having said that, I think in addition to fully understanding that when you go into a property portfolio you have to give it time, I think you can improve the performance of a property portfolio with market timing, and that's when we talk about those markets within markets that you're talking about, being able to look at the whole market and say, well, there's a particular market there, a smaller market, where I can actually get market timing right and get in just before maybe a big kicker or something big happens in that area, and I benefit from that gain.
Yeah, look, go against the masses in the market. Everyone likes a good thing and gets onto a good thing, and it's the people that get onto that good thing late that miss that cycle. The true believers and the people who do their research should understand there's opportunities in all market, but you're absolutely right, Margaret, in the sense that if you can time it reasonably well. I talk about volatility a lot in shares versus property, and there's no doubt that volatility in the property market is far less volatile than what we see happening in share markets, including today as an example.
Absolutely. Now, Anthony, there's no question that if you buy a property as an investment, you can improve its cash flows by claiming depreciation. Very often, depreciation can turn a property that might have a negative cash flow into one with a positive cash flow. In other words, the tax that you get back on depreciation can plug up that gap between between what comes in and what goes out, and sometimes then what comes in exceeds what goes out. What are some of the common things that people tend to miss with regard to depreciation?
The common misses these days are, there's a common misconception out there actually that older properties don't attract any form of depreciation whatsoever. So a lot of people just disregard that property straight away, whether or not they've purchased it or potentially looking at buying. Always look at older properties. There could have been a refurbishment that's taken place by previous owners. When that's the case, we're qualified as quantity surveyors to come in and estimate the cost of the work involved, and therefore you can claim depreciation on that work. Whether you're a renovator yourself on an older property, there's always scrapping involved. So if you're buying to renovate, you can get some immediate write-off there as well. And then certainly the smaller assets like bathroom accessories, exhaust fans, those sorts of things that are commonly missed as well.
Now, I love scrapping. There's no secret, if anyone watches this show regularly, that scrapping is probably one of my favourite things in depreciation, and people do miss that. And what they often do is they often go into a property, completely rip out a whole pile of stuff, replace it all, do their renovation, and then they call you guys in. They need you before then, don't they?
That's exactly right. Upon settlement, we revalue all of the plant and equipment within the property. If you were to go in and rip out the carpet, the blinds, the kitchen appliances, and then replace those assets, you can actually claim a write-off value for the original assets that were there before you started your renovation work. So it's a big thing for renovators. Not a lot of people know about it, but certainly at the end of the day, it's going to put more money back in your pocket.
Well, you know, the other thing that I like about scrapping is not only can you claim an amount for everything you've thrown out, but you claim their entire residual value in that 1 year. And sometimes people don't realise they could be throwing out $10,000 worth of stuff altogether, and they get to write that all off the day they throw it away.
That's exactly right. So there can be thousands of dollars worth of deductions. Once you've claimed those, you can start claiming the new assets as well.
And certainly if you then, I guess, Ben, if you do get one of those nice big claims from scrapping, get that nice big lump sum back from the tax office, be a good place to put that into your mortgage, wouldn't it?
Look, the offset account or on the non-deductible loans, definitely a great spot for that to live.
Absolutely, because for every dollar that you can save that way, that's $1 more property that you can buy in the future through leverage.
Correct.
So that's also a good plan. Okay, Ben, I wanted to ask you a question, and it's timely that we see that Harry Dent was here tonight with Peter Switzer. He's gone now, so we can say, you know, we can have our discussion. I was reading his forecast today, and in a nutshell, Harry's basically saying that what he's expecting to happen is that we aren't going to survive the second financial crisis as well as we did against the first one, simply because, or his main premise is that China is now growing too fast, they've built too much property, that they've gotten ahead of themselves economically speaking because of our links to China rather than to America, that it's going to impact back on us. What do you think about that?
Look, he's also spends a lot of time talking about demographics and talking about those drivers in terms of people moving into the baby boomers going to sell off property, and that's going to be a driver for oversupply, which is going to then obviously affect supply, which will affect value. That's where he's coming from. Look, I'm not a big believer in that. I believe our population is sustainable and growing reasonably well. So when you think about the numbers of properties that are being built each year, which is roughly between 120 to 160,000 new dwellings a year, there's got to be demand sitting behind that. You know, we are in an undersupplied market at the moment. So I think from that point of view, I keep coming back to the fundamentals. If people have got the opportunity to be employed, and they're being employed and earning the incomes that they need to, and they're within their affordability means, then they're going to be very well received in terms of buying more property.
Okay, well, look, let's come back to that undersupply in a moment, because there's a news story from the weekend I'd like to talk about. But for now, Mick from Melbourne, you have a question about where to buy.
Yeah, that's right. So I want to buy in the range of 300 to 350. My circumstances, I'm going to move into Western Australia for a new job. So I'm not sure where to buy the investment property, but I'm open to buy outside Perth or Melbourne or any interstate properties.
Okay, so you're looking not to buy an owner-occupied property, but you would like to buy an investment property, is that correct?
That's correct.
All right, well, let's go to you first, Ben. You're, of course, from Melbourne. You're very intimate with that market.
Certainly am.
Do you think that's where he should be buying?
No, I think at that sort of range I'd actually be looking at sort of some of the Queensland opportunities where we're looking in that sort of range around the Brisbane market as a bit of an example as well. We're seeing some opportunities in that market because we believe everyone else is not seeing opportunities in that market. So it's a market we like to be in before people realise that there was an opportunity and there's value in that market. So I'd be sort of looking around, apartments that have got really strong demand, low vacancy rates, in good areas where there's good employment opportunities. If we're talking in sort of city locations, if we're speaking outside of that, I will say that we're reasonably bullish on Geelong at the moment, but we've got to pick the areas of Geelong. We don't like the newer areas in terms of the new developments. We prefer to buy existing properties, and that sort of price range you're going to be able to get yourself a bit of land with a dwelling on it rather than a unit.
Anthony?
All right. Well, Mick, firstly, you've got a bracket there of 300 to 350,000, depending on what your strategy is, whether it's buy and hold or if you're looking for a quick turnaround. But certainly there's plenty of areas out there Australia-wide that will offer good returns. Rental yields are obviously a major factor in being able to maintain the property, and certainly when it comes to depreciation, you can pick up a brand new house or unit for that $3,000 to $350 mark, and it's going to give you $7,500 to $8,500 worth of deductions in the first 12 months alone. So, look, over the first 5 years, there's certainly going to be some good return there for you. And if you're lucky enough to get some extra capital growth in that 5 years, fantastic. But look, just keep an eye out for bargains and go from there.
I love the way Quantity Surveyors look at buying property. Mick, look, I think that there's some good opportunities in Adelaide at the present time. I'm a little bearish myself on all of Melbourne simply because I think that the best time to buy in Melbourne was at the beginning of 2010, end of 2009, and I think it might be a little late for many of the better areas to buy in there in terms of their growth potential. With regard to Perth, I don't think you're going to be getting anything for your 300 to 350,000 that is going to be worthwhile you buying, and I also think that Perth has another 5 to 10% to lose in terms of capital value. Remember, most of Perth, almost all of the suburbs, are returning at best a 4% yield and at worst a 2.5% yield. So you've got a long way to go in terms of making up that difference in depreciation if you decide to go ahead there. If you go to Adelaide, 300,000 will get you very nicely into the Onkaparinga Shire, and I'm thinking places like Seaford and Christie's Beach, a little less if you want to go to Huntfield Heights and maybe Hackham, which really will be the performers there, I think. They're undervalued at the moment and the locals don't want to buy in those areas, and I think there's some really good buys there. Yields are around about 6.5% to 7% as well, and they'd be a place that you could certainly get into quite easily. Properties that are probably about 10 to 15 years old with some depreciation still available on them, and certainly very high demand for rentals at the present time. Well, if you watch every week, you'll know that we give one viewer the chance to receive a copy of one of my books. All you have to do is to ask us a question, either via the telephone or in an email. Then the panel and I will choose one question and we'll send a copy of one of my books. Now, this week, the chosen email will receive my new book, Investing in the Right Property Now. And if you'd like to know how property investing has changed since the GFC, this is the book for you. Now, get to the phone to make your call or to your computer to send an email, then make sure that you watch at the end of the show to see if you're the lucky person. It's time now for us to take a short break, but stay with us. After the break, the panel and I will be taking more calls, and of course we'll start to answer some email. Welcome back. You're watching the property edition of Your Money, Your Call, and tonight joining me in the studio is Ben Kingsley from Empower Wealth and Anthony Booth from BMT Tax Depreciation, and we'd like to answer your questions. Now, if you have any property question, you can call us on 1300 30 34 35. Of course, you can also email the question to property@skynews.com.au. And Angela from Newtown, thanks for being with us. You have a question about tax depreciation.
I do. Am I able to claim the residual value of a fixture or fitting if I purchase it second hand?
Oh, that's an excellent question. Anthony?
Yes, well, Angela, if depending on the asset itself, and obviously the cost of the asset. If it's run its effective life, at the end of that effective life, the residual balance would be zero. But if it's replaced after, say, 5 years and it still has a residual value on it, then yes, you can claim a scrapping value for that particular asset.
Excellent. Nice and simple, Angela. Make sure that if you've got any other questions like that, you give them a call over at BMT. I find that I can ring them up and ask them anything, and they're always really, really good. And a lot of my own clients call them even when they haven't retained them yet to do a quantity report for them or a tax depreciation schedule for them. And they're great down there, so that's a little plug for them. I don't get paid to say that, but they are really very good. Well, I'm often asked about how best to use available cash, which eventually has another purpose earmarked for it. This week, Darren writes, I have a temporarily spare $150,000. Nice for Darren. This money will eventually be eaten away over 6 months with a renovation on my home. Do I offset this against my $300,000 home loan, saving interest? And if so, will I be taxed? Do I term deposit for the best interest and put interest onto my investment house loan of $160,000? If I do this, I believe I will be tax exempt and possibly save interest on my investment loan, but this interest is tax deductible, I think. How do I best manage this menacing $150,000 to my best advantage? Ben, apart from telling him to send the menacing $150,000 into us,
yeah, we'd be
happy to take it off his hands and look after it for him. Now, of course, the thing is here, we can't really give him advice here because he is asking a financial question. It requires good financial advice. Someone needs to have the right kind of licenses to even tell him what to do with $150,000. Having said all of that, typically sometimes people have some money sitting around and there's a lot of options that they can have, and I think there's a couple of parts that he might be confused about where tax is concerned.
That's
so
exactly
what's some general pointers that you can give to Darren?
Some general pointers are these, Darren. In terms of the interest that you're going to be offsetting on your loan, let's assume that that's 7% hypothetically. Now, instead of that, let's assume you put it into a term deposit that earns you 6.5%. The interest that you're earning on the offset account is basically saving you interest, so it's not actually earning you income, so to speak. The interest that you have in an interest-bearing account is earning you your income, which will actually then be added to your overall income for that tax year. So in a very simple outcome on this, I would suspect that putting the money in the offset is the best way to go, given that it's going to be drawn down for the renovation into the future.
I think you might just have Darren, all of your tax laws just a little bit confused about what you will be taxed on. Quite simply, if you put money into either an offset account or directly into a line of credit or a loan, which essentially has the same effect of offsetting interest, there's no tax for you. What you save is what you save, the whole dollar, and you won't be taxed on any of that. You won't lose any tax advantages anywhere else either. The thing about it is that it's probably best to put it into offset rather than straight into the loan, because that way, if you want to take it out later on, you will preserve any tax deductibility that might be on that loan in the event that you turn that property into an investment in the future. With regard to your investment loan, if you pay off an investment loan, you do lose tax advantages. But I don't want people to get too caught up in that, because it's still important that we repay debt all of the time. And for the amount of lost tax deductibility on interest when you do pay amounts into a loan, it doesn't matter so much. You're not losing that much. If you paid $10,000 off a loan, you'd only lose $210 in tax advantages, but you gain $10,000 of ownership in a property portfolio. In your case, that doesn't really apply because you're drawing it back again. Probably best for you to offset any, first of all, personal debt that you have, then offset any investment debt you have, but put it in an offset account so you can easily get it back without messing around with the original tax deductibility of any of the loans that you do have. Roger from Canberra, you've got a question about Braidwood.
Yeah, hello, Margaret. Yeah, love your show. Watch it every Monday night.
Thank you.
Yeah, Braidwood, New South Wales. I was wondering if you could comment on that as a place to invest.
Absolutely. Now, this might be one you're not familiar with, Ben.
It's not on my radar at the moment.
How about you, Anthony? Are you not overly familiar with Braidwood as well? Okay, what's leading you to thinking about Braidwood? Because often people get suggested areas by people who are trying to sell them property there, and I'm wondering if this is the case for you.
Well, there's a proposed gold mine to open up near Braidwood in Majors Creek.
Yes. Okay. Yes.
It hasn't been. It was approved, but it's under appeal.
Yeah, exactly. I guess the point that I would try to make is that whenever we buy property as an investment, we really need to be careful that we don't choose an area based on one thing that we think is coming up. I get people who come up to me at expos all the time and say, I'm thinking of buying in such and such a suburb because there's a hospital opening, or because there's a new railway station, or because there's a new road going through. Those sorts of things, including a gold mine proposed or otherwise, might provide a very short-term boost in growth, but unless there are other drivers to support that growth, then it will be just that. It'll be short-term and then it goes away after a while. I suspect with Braidwood, and I don't know Braidwood as intimately as I know some areas, but I know some things about it, and what I know is that there's not a lot of other things supporting a buy there at the moment, not a lot of other intrinsic growth drivers. Always remember that it's the concert of factors all behaving together that make an area grow not only tomorrow but well into the future, and make your owning property there worthwhile over the long term. I think there are going to be better places for you to spend the same money that you would spend in Braidwood, where you're going to get better kinds of growth. Even places like Bathurst and Orange will be a better investment, I believe, than Braidwood for you. Maurice from Darwin, you're asking about Perth.
Yes, that's right, Margaret. I watch your show all the time and I love your advice.
Thank you.
Okay, we have a property in Darwin and we're moving to Perth later this year, and I'm just wondering whether it's a good idea to buy in the market as it is now. I would like to live up towards Yanchep on the coast where all the new homes are being built, and you can buy a decent home for around $400,000, which is pretty good compared to Darwin.
Yes.
So do you think it's a good idea at this time to buy in an area so far north of the city?
Do you own your property in Darwin?
Oh, not fully, no, not yet.
What would the plan be with the Darwin property?
We're going to turn it into an investment property.
Do you owe very much money on that?
Well, it's valued at around $700,000 and we probably still owe around $400,000 on it.
Okay. And in terms of Perth, that would be an owner-occupied property as well, correct?
Exactly, yeah.
Okay, and I'm assuming that if you buy up in Yanchep, then you'll need the $400,000 plus the cost, so it'll be fully mortgaged and then some.
Yeah, most likely, yeah.
Okay. You'll see what I'm getting to in a moment, and I know that Ben's smiling over here because he already knows what I'm getting to here. Before we get to the financial technicalities of this question, let's just consider Perth. Are you familiar with Yanchep?
I am familiar with the area.
So Yanchep is obviously quite a fair way north, although in Melbourne and Sydney terms it's not.
No,
it's very close.
It's northern beaches, but anything 25 minutes away in Perth is a neighbour.
Well, the thing about it is that the building goes all the way up to just north of Ocean Reef, around the Beaumaris and Iluka estates. Then there's nothing, and then there's Mindari Keys, and then there's sort of nothing and a little bit more, and then there's Yanchep. There's no immediate plans, at least in the next 20 years, to fill in between. Having said that, they're very big on master planning and neighbourhood shopping centres in Perth as well, so there's really nothing to go into the city for. In fact, if you go into the city on the weekend, you realise that there's nothing to go in the city for. So really, urban living is very, very much the kind of thing that they're into over there. What do you think? Well,
the first thing I would be asking is, if this is a lifestyle choice, then, you know, if there's an investment outcome that you're trying to achieve from this, then obviously I like the idea of holding on to Darwin and then looking at, if you're going to stay in Perth for the long term, then, you know, this is a lifestyle decision, and I think in that area over the longer term, being coastal, you're going to see some growth over the long term. That's probably where my sort of advice would come from. It's like, well, what are the overall objectives? What are the plans? How are you going to cash flow this? What sort of lending do we need to do? How much stress is it going to put on your financial circumstances? They're the types of questions. But in a general theory, I don't like selling property for the sake of selling property. You know, the Darwin property might be a very, very good yielding property. You've done a lot, you know, you've invested in there wisely. So the way I look at it is, if you can afford it and it's part of your long-term plans, then, you know, I support it.
You know, this is a little bit of a tricky one because I don't like it when people move out of a capital gains tax-free asset, which is your family home, and then raise a large debt on a new property that is going to then become their family home and turn that old family home into a capital gains tax attracting asset that becomes their investment. I also don't like to see people upside down financially where the biggest debt they have is that non-tax deductible debt on their family home. It's a little bit different here, although not entirely different, in that you're talking about debts of a similar value. Therefore, you won't necessarily have the biggest debt on the family home that you're moving into. That will be about the same size debt. Ben's right when he talks about the fact that when you're making a lifestyle choice, you really shouldn't have an investment outcome in mind. We buy property for its lifestyle reasons, and if you're very familiar with the area and you're prepared to live in South Geraldton, as the people in Perth will tell you, up there in Yanchep, I think it's going to be a really nice lifestyle choice for you to make. It's certainly a good area. I don't think you're going to see any growth there for some time to come. Perth itself is suffering from a fall in values, and investing so far out of what the local people think as being the main area to live in would mean that you're buying a property that's got some time to go before it sees any major growth. So I would like you to consider whether or not you've already got as much as you can get for now out of Darwin. The Darwin market is just starting to peak and stabilise. When you think about it, you could realise $300,000 in cash out of your Darwin property with no capital gains tax on it. Pay off the debt, use the $300,000 to buy the property in Yanchep and move in with a small $100,000 mortgage which has no tax deductibility but won't cost you much to support. And then you'll have $300,000 worth of equity in the Perth property that you could then leverage back into other growing markets that haven't had their big boom yet. So into those kinds of markets in Adelaide and some of those Queensland markets that will have good yield for you and a better outcome all round in terms of depreciation and everything else. You need some really good advice on this one. I don't think there's anything wrong with the area that you're considering. I'm just not sure about the strategy for keeping that property that you're moving out of. Thank you for the calls and emails so far. There's still plenty of time left to get yours in, so don't waste any time getting to your telephone, computer or your iPhone. Now it's time to take a short break, but we're coming straight back. So if you do have a question for anyone on the panel this evening, remember the question of the week will receive a copy of my new book, Investing in the Right Property Now. So call us on 1300 30 34 35 or email us at property@skynews.com.au. Thanks for staying with us. You're watching the property edition of Your Money, Your Call, and this is your chance to get an answer to any of your property investing questions. Tonight you'll be speaking with Ben Kingsley from Empower Wealth and Anthony Booth from BMT Tax Depreciation, and of course I can also answer any property investing question that you might have. So call us now on 1300 30 34 35, or you can email us on property@skynews.com.au. And Leon from Kuranda, you're calling about fair value.
Yes, that's right. I'd like to ask the panel, what are one of the formulas you could use, or a reliable formula that you could use to try and determine what is fair value for a property?
This is a really tricky one, Anthony. Fair value on a property, there's not really a single formula that applies all over the country, is there?
No, that's right, Margaret. And essentially, fair value on a property really comes down to what someone's prepared to pay for it. So that's where the market gauges obviously what a property is worth. But in terms of looking at historical data and current, valuations on other properties within the area, there's really no true fair value for a property itself.
And it doesn't even relate to rental yields either, does it? Because in some areas you'll get a 4% yield, in other areas you'll get a 7% yield, and it could be fair in both areas.
That's exactly right. So at the end of the day, as long as someone's prepared to pay what you're asking for it, that's a fair value. But they look at a lot of comparatives, and obviously if your property's superior, inferior, or to another property on the market, or something that's just sold, but you can't really put a fair value on property.
And I guess, Ben, the one exception to the rule of whatever someone's being prepared to pay for your property being fair value might even be the auction process, because I've seen many times when people just get all emotional and overheated and competitive at auctions, and the properties will sell for way over what I would have considered to be a fair value for them.
And they may not be valued up by the value at fair market value. I mean, and the buyer may be a developer. And so you're thinking, how can they do that? So when you're doing this, Leon, there's a couple of things that I would advise you on, and it's the same thing with our buyers advocacy business when we're trying to establish fair market value. Comparative sales of like properties are really important. They're a good test within a 1 kilometre radius and sold within the last 6 months. You'll hear valuers talking about that when they're doing appraisals and valuations for their lending partners. So the way on which I would look is fair market value, and the terminology fair market value means what an unrestricted buyer will pay an unrestricted seller, basically, is what they're trying to ascertain in that sort of fair market value. So look at comparative properties of similar build, similar construction, similar age. So, don't get caught up in something that's 10 years older than another property. That's where you'll find fair market value in your research.
And most importantly, Leon, understand that the prices that people have their properties listed for does not necessarily represent market value at all. And when you're considering what your property's worth, you don't look at what other people are listing for, you look at what other people have sold for, because sold prices are the only ways that valuers really try to get a handle on values. Market value is what people will pay for a property, and that depends on what's sold in your area. John, you're from Cairns, just down the road from Kuranda. You've got a question about Moreton Bay.
Yes, love your show, Margaret, and thank you, and good evening to the panel and you. Look, I've got some queries about the Moreton Bay area, Russell Island, Macleay, and all the islands around there, Carragara. What's your feeling in investments there? Because the property is really, really cheap, and I can't understand why it's not. It's undervalued, in my words, anyway.
Yeah.
How do you feel about that?
Look, Moreton Bay it may be a little bit undervalued, although there has been a significant increase in prices in a lot of the areas around Moreton Bay. Ben, is that on your list? You talk about Queensland properties. What do you think of
it's not on my list, John, and one of the reasons why is that there's a variable about getting out to some of these communities and going to find employment on the mainland, so to speak, if you're looking at some of these island areas. So I think as a lifestyle choice, I have no problem with it all, but certainly long-term investment, if something was to go wrong where you couldn't access your employment for a long period of time, boats, transits, whatever was going on, that's just too high risk for me and too high risk for my clients. So that's why I'd be steering clear of those areas.
And look, John, typically island investments don't come out that well for all of those reasons, no matter how close to the mainland they are, because of the fact that there's only so much that can happen on an island, there's only so much infrastructure that can go on there, there's always going to be that barrier between the island and the mainland that needs to be crossed, there's always a reason why it can't grow and prosper, and it's a little too small to have its own thriving microeconomy. The other thing that tends to happen in those island communities is that the money tends to always go back onto the mainland. So when people are working and playing and being back on the mainland, that's where they're spending their money, and so they don't have much of an economy. You need a thriving and vibrant economy in an area in order for it to grow. Having said that, there are parts of Moreton Bay that are part of the mainland, and some of those areas, certainly in the Moreton Bay Shire, are going to do quite well, although not at the top of my list of hotspots, and that's all the areas up around Kalanga and Redcliffe. We've already seen Redcliffe do pretty well. It's had a bit of a flattening. It looks like it's got a little bit of life left in it again, so maybe still a similar area, but back onto the mainland a little bit might be a better bet for you. Well, our next email tonight comes from Kim, who has a question about capital gains tax, and she asks, I'm building a new house for residential purposes, but I aim to sell it after 12 months to take advantage of zero capital gains tax. I'd like to know whether the 12-month starts from the date I bought the land or from the date I started living in the property. Probably one for you again, Ben.
Sure.
I think she might be a bit confused about the whole capital gains tax issue.
I think she is. Look, I'm not a tax expert, so I'd always say, get good tax advice in this situation. But if you're building a property to sell, and that is your primary intention, I would talk to your tax advisor, because technically that's not for owner-occupied purposes. So you may be in for capital gains. Now, that's a principal place of residence. What you're talking about with this 12-month rule is a 50% concession that may be applicable if it is for investment purposes. So that's probably where I'll leave it in terms of just understanding those points. And before you do make the sale, I will finish with this final point, and that is understand your return on investment. You're saying you're going to sell it in 12 months' time, but when you add the interest and the buying costs to acquire that, is it a smart move? That's what you want to be considering before you make that decision.
And I guess, Anthony, that if it is going to be a property that she's building for investment, regardless of how long she keeps it for, there's going to be some depreciation benefits involved.
Certainly, Margaret. And look, if it's going to be a brand new build, there's going to be some high amounts of depreciation applicable to the property itself, not only on the building but also on all the plant and equipment. So, look, even after 12 months, reevaluate your situation, see how much it's going to cost you to hold, and look at maybe a holding pattern instead.
And what's the story with that? If you take delivery of a brand new property from, say, a builder, do you have a quantity surveyor's report prepared, or do you have to get all of the invoices and the costs from the builder?
No, look, if you've got a total cost from the builder, we're actually obliged to use that cost in terms of preparing the report, but we don't need a breakdown. So we can actually walk out there, have a look at the property itself, use that total figure, and then we can estimate the costs involved with the building itself and then all the plant and equipment inside.
Okay. And of course you're going to need to have that breakdown for when you're claiming, because you claim all different items at different rates.
That's exactly right.
Okay. So hopefully, Kim, that helps you out a little bit. The important thing for you is to really establish it's difficult to answer your question as to whether or not it's actually going to be one that you build to sell and then decide to live in, or whether it's an investment property or not. Before you do anything, get some really good advice on exactly what the laws are of the day, so that you can make sure that you do maximise all of the tax advantages that you could be getting out of that. Certainly, if it's an owner-occupied property that you're going to be living in, it's a capital gains tax-free asset. If it is an investment property, then it's going to be capital gains tax at the full rate if you sell it within 12 months, and at a 50% discounted rate if you sell it after the 12-month period. AJ from Melbourne, you're considering buying in Perth, I believe.
Actually, I was just calling on behalf of my friend's dad, and I love your show, so I was talking to him about it. He's thinking of moving to Perth. He's actually got a property in Aura near Wagga, and he's moving to Perth for family reasons. His wife passed away. He's got $100,000 saved up, and he's not sure if he should sell his property and move to Perth, or should he just leave the property that he has and use the money, the $100,000 that he has, to buy a property there, while using the property in Aura as an investment property?
Do you know whether or not he has debt against the property down in Aura?
Absolutely nothing. He has no debt, but he has absolutely no super either.
Okay, all right. Okay, Ben, I guess this is very similar to the one that came in before, in that potentially what we're going to be doing here is using the $100,000, which isn't going to get him anything in Perth. It's only going to be probably a 20% deposit on something in Perth, which would mean he'll have a debt of about $400,000 and a debt-free investment property back in Ara down near Wagga.
Look, and you've got to look at each case on its merits, and I would say to this person that you know, just make sure that you do the research on what ARA is going to do in terms of an area. It's not an area that I'm familiar with, so I put a question mark around that. And then obviously in terms of the Perth market, there's potential opportunity there as well. So the numbers will tell the story, and the research will tell the story as to what the best way forward is for you.
And look, if from a numbers perspective only, and I think Wagga's not a bad investment, but I think if you're going to be having an investment in Wagga, it needs to be right in Wagga itself. It's certainly not at the top of my hotspot list, but from a numbers perspective alone, he's facing having a large mortgage, which is going to cost him a considerable amount of money, and I don't know whether he's already retired or whether he's going to be working there, but he may not even be able to raise the debt for that if he's not working. He's talking about having a large mortgage on a property in an area like Perth, where most of the places that you're going to live in Perth aren't going to be doing overly well from a growth point of view for a little while. And then he's talking about getting probably not a great amount of rent on a property that's he's got absolutely no debt on, so no, that'll be taxed, any money that he does get on that. It could be possible, and again, I don't know your friend's father, but he needs to get some good advice on whether or not financially he's better to sell Wagga while it's still a capital gains tax-free asset, use the proceeds from that, 300, maybe 350,000, take that with his 100,000 and buy a property in Perth outright. But then, if he wants to have something for his retirement, use that equity to leverage back into other investments in better areas. We've talked about some of them already on the show tonight. For that amount of money that he would have, areas like maybe Warrnambool in Victoria, the Onkaparinga Shire in Adelaide, some of those southeastern suburbs in Brisbane, the Logan Shire, out to Toowoomba, up into the Surat Basin even. They're all areas that have probably got better prognosis for growth than both Wagga and Perth, and areas that he could do really well if he invested in them. Well, thanks for all of your questions so far. It's time again for another short break, but we'll be back. And if you'd like to call up and ask any question about property, call us now. There's a bit of time left on 1300 30 34 35. You can also email us at property@skynews.com.au. Welcome back to the Monday night property edition of Your Money, Your Call. I'm Margaret Lomas, and with me on the panel tonight is Ben Kingsley from Empower Wealth and Anthony Booth from BMT Tax Depreciation. There's still some time left for you to call and ask us any question about property investing. The number is 1300 30 34 35, or you can email us on property@skynews.com.au. Before I go back to the phones, Anthony, in the break you told me that you used to live in Moreton Bay.
Thanks, Margaret. Yeah, just a quick one on the area itself. I noticed John was talking about Russell Island, Clay Island, and a couple of the other areas around there. Look, the biggest thing with the islands around there is the ferry access from Cleveland and Redland Bay, so that can cause a bit of havoc. In terms of depreciation, look, some excellent opportunities there for depreciation, as construction costs are higher, obviously, to get materials onto the islands and labour and all those sorts of things. But look, at the end of the day, if you can afford to do it and that's where you want to buy, maybe you want to retire on one of the islands, go for it. But yeah, just a little bit of inside knowledge there.
Excellent. It's always good to have a little bit of the inside track. Richard from Sydney, you've got a question about property values.
Thanks, Margaret, for taking my call. I would think, going from the last callers asking on valuation of properties, a more easier method would be a simple price-to-earnings ratio, meaning the amount you would take for a yearly rent, multiply that by the amount of years it would take to pay off that property. I mean, in worst areas, it's at least 20 times, rising to astronomical levels in the so-called blue-chip areas. I really think people should be cautious out there, and otherwise they'll find themselves in servitude to the banks. Thank you.
Thank you for your call. Unfortunately, Ben, a price-to-earnings ratio works lovely when you're trying to buy a share, but it really doesn't translate well into a property market, does it? Because property is so different to how it behaves than shares, and the demand factor really figures. I mean, he's right, it would be a great, fair way to price property, but it doesn't translate that well into property markets.
When I talk to economists and analysts, there's a couple of things we talk about. In commercial property, it actually has a merit. There's, you know, it certainly is one of the ways in which people can potentially value the return on their investment and the value of the asset. In terms of property, when I bring up one simple point, is that people have to live somewhere. The moment we talk about having to be accommodated somewhere, that brings a whole new variable in. You don't have to have your business running out of that potential office space. You don't have to have it running out of that factory. But when we talk about accommodation and people's choice where they want to live, and those growth drivers, it pushes that completely out the window.
Yeah, it certainly does. And there's just no relationship. If you look all around the country, the price-to-earnings ratio in one area can be wildly out of sync with another area, and even in another area fairly close by. And if you're using that as a way to see whether or not you're getting fair market value on something you're about to buy, it's probably going to be off the mark every single time, and you'll never buy anything because it's never going to stack up under that particular formula.
That's right. You go back through history, and if you're using that formula, it wouldn't stack up either then.
Yeah, exactly.
So you've got to look at it and say, well, that's something that doesn't quite gel in residential property.
And I think you're right. I think the reason why it doesn't gel is because of the human factor that we have when it comes to buying property. So thanks for your call, Richard. Dean from Menai, you've got a question about Mount Druitt, I believe, and superannuation?
That's correct, yes. The wife and I have just set up a self-managed superannuation fund. We've got about 320k. Now, we were looking at buying 3 properties out at Mount Druitt for around about 220,000 each. Now, the rental return on those properties would be around about 300 a week each. And our employer also gives us 700 a fortnight in superannuation. I'm just wondering if it's a good idea or not.
Okay. All right. Well, maybe you can give us a comment on Mount Druitt and what you think of that area, Anthony.
Look, Margaret, Mount Druitt's always been a good area for new developments of late. It has had a bit of a name in the past, but that's certainly fading. But we've seen quite a few new developments pop up in the area, and therefore depreciation will be high. Certainly in a self-managed super fund, you're looking at a lower tax rate of 15% instead of your standard 30, 37 to 45 if you're in your own name. But certainly at the end of the day, the depreciation will stack up. And look, if you're getting $300 per week rental return on a purchase of 220k, it's certainly going to be
Sounds
worthwhile.
Positive cash flow, doesn't it? Ben, have you got any comments on the strategy?
I do, Margaret. Dean, thanks for the call. First of all, one of the big things I would talk about here is basically, making sure that you spread your risk. You need to look at, you're talking about buying everything in the one location. What happens if Mount Druitt doesn't perform to your satisfaction? So diversification is a really important point that I would make here in terms of protecting your capital base inside your self-managed super fund. In terms of Mount Druitt itself, it's not on my radar, but you've obviously done some research there, but I would encourage a bit of diversification in terms of what you're looking to move forward to doing.
And I'd like to just move on to the question about the superannuation fund itself. And I know that everybody is looking to tap into their superannuation funds to invest in property. And certainly a self-managed superannuation fund might give you an opportunity to buy property that might otherwise have a little more risk than you'd be prepared to take by buying property in your own name. We tend to be a little bit more careless with our money from a super fund because our employer's putting it in there for us and it's not really our own money. There's a couple of things I really want you to know, and I wrote extensively about this in my new book because I think too many people are getting onto the self-managed superannuation bandwagon, and that's that, first of all, it can be costly to set up a superannuation fund. It can be costly to run one and to have it audited every year and to have all of the things required. I've just had my self-managed superannuation fund done for the year, and it cost me $5,000 just for the accounting work on it, which means that the pressure is on that fund to really outperform anything else there. The other problem is that the compliance requirements are huge too. You've got a lot of requirements to make sure that you're investing prudently, and so it's not quite as easy, and borrowing is very, very confusing and complex. It's not a straight loan to the superannuation fund, it's a loan to the trustees of the superannuation fund through a warrant arrangement. You've got to set up another trust to be able to take the loan who holds the property on behalf of the super fund. Already I'm confusing you, I confuse myself when I talk about it, and I think you need to be careful that you take the right kind of advice before you delve into investing in property in superannuation funds. It's certainly not the piece of cake that it's made out to be. Gemma from Sydney, you're our last caller tonight and you've got a little bit of time to ask about bigger waters.
Yes, I just wanted to inquire about we're thinking of purchasing a waterfront property up there.
Okay, is this to live in?
It will be eventually, so in a couple of years.
Okay, so for now it's an investment.
Yes.
Yeah, Ben, I'm not always comfortable about these mixed-use buys. People buying an investment, they go, oh, it's a great investment, I need to buy it because then I want to live there one day. Especially the bigger waters. The Gold Coast at the moment is just so far on the bottom of my hotspot list. It's actually in the, like the freezing part of the list.
Yeah, the Gold Coast is struggling. That's definitely the case, Gemma. And this is a long-term play, and it's something you're looking to do from a lifestyle point of view. I suspect your money may be, better used elsewhere, and then with the exit strategy into getting into this location in the longer term, depending on, what sort of timelines you have, and obviously a lot to do with your cash flows and your financial circumstances before we, give any advice to you. We'd want to look at all of those types of things. But just, yes, the market's depressed up there, so you see it as an opportunity. I understand that. But how long is it going to be flat for? And I just don't see the growth drivers in that marketplace at the moment.
And I can tell you now, I think it's going to be flat up there for a long time. You've got time to go and invest in far better markets, and later on when you've made your money elsewhere, take it out and then buy in bigger waters, it won't have moved much in that period of time. Well, that brings us to the end of another show. Of course, I'll be back again next week, and joining me will be Michael Tees from Tees Lawyers and Stuart Wall from Bell Partners. So get those questions ready. You can email them to me during the week, and I'll do my best to get them answered. Our question of the week this week came from Nick from Melbourne. Nick, you asked about spending $300,000 to $350,000. Now, I'll be sending you a copy of Investing in the Right Property Now. Just send me an email to yourmoneyyourcall@destiny.com.au, and I'll send that book out to you. That's yourmoneyyourcall@destiny.com.au. Thank you to our guests, Ben Kingsley from Empower Wealth and Anthony Booth from BMT Tax Depreciation, who will, of course, be back again very soon. And in the final episode of Property Success, this weekend we're headed to Armidale in New South Wales. You can catch that show on Sundays at 1, 5 and 9 p.m. I'm Margaret Lomas. Thanks for your company and have a great week.
The information featured in this program is general in nature and therefore should not be relied upon. Guests appearing on the program may have commercial arrangements with some of the companies mentioned. Before making any investment, insurance or financial planning decisions, you should consult a licensed professional who can advise whether your decision is appropriate for you.